All right, let's talk some bonds in the big picture centered around the Fed. Mr. Collin Martin joins us, Director and Fixed Income Strategist at Schwab's Center for Financial Research on an inflation week. You're the man. Appreciate you being here, Collin. So tell me what you learned these past 5 days.
Well, it's been a pretty busy week. I think yesterday was a little bit surprising with a better than expected CPI report, although we got a little bit of relief there with the PPI report. When we look at those reports, I think it's important to point out that, if you look at the corporate side of the equation, because it's something that I focus on a lot of corporations are those producers who are passing that along. But it showed us that if the disinflationary trend, especially today, still appears to be intact. If we looked at, again, just that CPI report, we saw yields rise a little bit initially, and maybe there's some cause for concern that inflation could remain sticky given that strong jobs report we saw last month. But again, today gave us a little bit of a sigh of relief. So that's the good news. We also got a ton of info from Fed speakers. We got the FOMC minutes. What we learned there was that we have a wide range of views. And when we look at the meeting 2 weeks ago, there was one dissent. But when you dig deep into the meeting, you saw that there were actually some members who would have been more comfortable with a 25 basis point reduction versus that 50, although they came around and ultimately voted for that 50 basis points. So I think going forward, given what we've seen with the strong labor market and inflation that's been sticky the past few months, I think it's going to be an interesting debate at that early November meeting.
Okay. That's, it seems a welcome thing by the market right now. Spreads are tight. Stocks are at highs. Seems like we don't need another big 50 bips. What do you think?
I'd say 50 basis points is not needed right now. If you look at the futures market, there's not even a full 25 basis point cut priced in just yet. In other words, there's not a 100% chance of a cut in November. And that's something that we've heard from some of those officials, specifically Bostic yesterday, who mentioned the idea of potentially pausing at one of the upcoming meetings. That is a possibility right now because things are looking good. I mean, you hit the nail on the head, Oliver, where things are going smoothly right now. The economy is chugging along. We're seeing upward revisions to GDP. We saw a very strong payrolls report. We're seeing inflation that, although ultimately trending lower in the grand scheme of things, maybe it's stalled out in the past month or two. When you look at all that together, there's certainly not a case for a 50 basis point cut. And it does open the door for a pause in one of the upcoming meetings. We're not there just yet. We think that a 50 basis point or a 25 basis point cut should come in November. But again, we have a lot of time before we get there. If we get some really strong data between now and then, maybe the Fed does pause. But adding all that together, we also see very loose financial conditions, as you alluded to. High stock prices, low credit spreads. Things are looking pretty good in the economy right now.
When you're gauging the credit side, Collin, going into earnings, does that give us an opportunity to take on a little bit more risk, go for a little bit more yield? Does that spectrum widen out a little bit in the quality or lack thereof one should tolerate?
We wouldn't be taking more risk right now. In other words, we wouldn't be adding to the riskier bond positions right now, mainly due to valuations. The story of the credit markets are strong fundamentals, but really, really rich valuations. On the fundamental front, we're comfortable with credit risk in general. We like investment grade more just because they have those high credit ratings for a reason. But if you look at just the overall economic landscape, with strong economic growth comes strong earnings growth. And if we look at the most recent comprehensive look at corporate profits, which we get from the Bureau of Economic Analysis, second quarter corporate profits continued to grow, hit a new all-time high on a pre-tax basis of around $3.8 trillion. Companies have a lot of cash in their balance sheets. And in addition to that, we're actually starting to see yields fall. So that can be a tailwind to corporations. With the falling treasury yields, we're seeing lower borrowing costs or lower refinancing rates. This is all really good news for corporations. But when you think about adding risk or taking additional risk, the extra yield premium you get or risk premium you get matters. And we're seeing very, very tight spreads. They're actually tighter in the investment grade space right now, which maybe makes sense because there's risks on the margins, but risks to a slower economy generally face the junk part of the market. But if we look at investment grade credit, the average OAS, the average option adjusted spread of the investment grade corporate bond index closed yesterday at just 81 basis points. That was touched back in 2021. And then prior to 2021, you'd have to go back to 2005 before you saw a spread that low. And in fact, given today's strong equity market performance, maybe we see spreads move a little bit lower from here. But it's going to be difficult to get them significantly lower. Given that historical context, given that we're back at 2005 levels, there's not much room for spreads to move lower, which means less room for outperformance relative to treasuries. So when we look at investment grade corporates, rather than the tight spreads that we're looking at, we're focusing more on the yield. And we've seen those yields pick up a little bit recently with the backup in treasury yields. And on average, with investment grade corporate bonds, you can still get yields now in the 4.5% to 5% range. And we still think that's attractive, especially as the Fed's cutting rates.
All right, nice. So no reason to get crazy and start getting gambling and risky, but you can rest pretty assured that most of your spectrum of like intermediate grade is going to hold up pretty well. And it sounds like some areas you can still get some decent yield too. So plenty of options abound. Thank you, Collin. Appreciate that walkthrough. Good stuff. A look at the credit markets.